Welcome back to our course on fintech risk management. We're going to give you some examples of operational risk. Now, in our last video, we talked about how operational risk has high tail effects, meaning unlikely but devastating. So let's talk about some of these long tail examples. Hammersmith and Fulham is an interesting story in unexpected operational risk, which led to market risk that was unanticipated by companies doing business with Hammersmith and Fulham. Now, this is a county or a township in the UK that got involved in derivative trades, and they started making a lot of investments as a county organization in these kind of speculative ventures, and they were making money and they were doing well and doing more and more because on average most of the time you're probably going to make a little bit of money, but occasionally the nature of derivatives is that you're going to have some big risk occasionally. And Hammersmith and Fulham as a county started making thousands of derivative trades, and they got some things wrong in a correlated way. They had some big losses, and rather than pay out and virtually bankrupt the township because their financial managers took some high speculative risks and lost, the township management, the board of directors of the city government, said you were never authorized to make those trades. And they went to court and they asked the court to deem that the managers involved committed fraud. They never represented the risk, they never had the authority to do these trades. And so thousands of transactions with banks on the other side of the transactions who had been paying out the profits on these trades for a long time, now when the losses hit and things go the other way, the township says, oh, we never authorized these. We never knew exactly what they were doing. We never understood. And therefore, we ask that these trades be voided. And the British judiciary said, we agree. These traders were never authorized. This was a lack of management. This was bad management. And on the other side of the trades, there were a number of banks that said, wait a minute. We never knew they weren't authorized. This is unfair. They were doing derivative trades like everybody else. Now you run into a market risk problem from the perspective of these financial institutions betting on these derivative trades. They're paying out when they lose, but when they win, the other party says, I wasn't authorized to be gambling with this money. I'm not supposed to be here. And so you have a problem. That's a risk both for the financial institutions on the other side of the trades, but also an example of an unexpected risk that is a very long tail event, in that for a long time things were going fine, trades are fine. What the courts declared in the case of Hammersmith and Fulham is, yes, you never authorized this, you never permitted it, therefore it was fraud, therefore it shouldn't have happened. But if it ever happens again, you're going to be liable because you now are on notice. And if you allow someone to do it again, that's clearly accepting of the risk. Kind of odd, but your trading partners may be able to get out of their trades if they didn't realize the risk they were getting in. And sometimes the courts will decide that against you and increase your risk as a financial institution because the other party didn't know what they were doing or didn't have permission to be gambling in that way. Barings is another example of a company where risk was taken up in an unexpected way because a rogue trader, which is what they call him after the fact, in Singapore, Nick Leeson, made massive trades in the Japanese market. Now, that was his job. He was the manager of the Singapore branch, and part of his job was to bet on currency directions in Japan. But he did his job beyond expectations. He went the extra mile, if you will. But in his case, he went the extra 1,000 miles. He went way beyond the levels of risk that he was authorized to do. And because he controlled the front end trades and the back end accounting systems and everything to do with the branch was all under his control, he was able to hide from London how much risk he was taking. And when things are going well, the London branch is saying, Singapore star, Nick Leeson's a wonderful guy. He's doing great things. He's a huge profit center. We're very, very happy. When things go bad, they went really, really bad. And a 200-year-old investment bank went under, gone, no longer on the map because of operational risk. Now you may say, oh, that's ancient history. Too long ago. Don't care. Long time ago. Okay, fine. But there are more recent examples of firms that have gone under. You may say, well, that one's 10 years ago. This one's 20 years ago. Well, the nature of these risks are that they don't happen every week. They don't happen every year. But when they do happen, they're big. That's this kurtosis effect, this fourth momentum, is that they're huge in impact and very unlikely, very unusual. But when they do happen, the effects are big. Algo trading is nice stuff and some of the highest returns in investment trading and in market funds is with computer trading. And the nice thing about algo trading is they're very fast and they're very good at arbitrage. They're very good at taking advantage of things and making some small returns over and over and over again. What the problem happens with algo trading occasionally is that these trading models are using the same statistics, the same estimations, and they're very good at tracking variance, very good at doing normal distributions. But when something unusual happens, everybody may be using the same model assumptions. And so it may react in the same way. And so these trading systems may have positive feedback loops that become erratic. And so in October 1987, we had a meltdown in financial markets because of algo trading. Fast financial trading models caused the stock market indexes to go down, 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 down very quickly because everybody started selling when somebody else started selling. And so we have this high variance effect, is we're all able to make a little bit of money on arbitrage, but the liquidity is low, and then the market reacts too much to a small trend. We can see that today, not so much in the stock market indexes, and some of the algo trading models don't react as much as they used to, or there's some more variance. But we do see it in terms of things like cryptocurrency trading being highly volatile and unstable. And so a little bit of news can cause an overreaction up or down and a high degree of velocity, which can be a lot of fun. It's a roller coaster, but it can be a lot of risk as well. Hedging versus speculation can become a problem. When hedging is good, hedging means reducing your risk by using derivatives to reduce your operational risk of your company by investing in activities that are not positively correlated with your company's performance. So Cathay Pacific is an airline. They invested in hedging by hedging against oil prices going up. So they were able to bet on effectively bet financially or with financial instruments that oil prices would go up. Now, if oil prices go down, that's good for Cathay. They make more money as an airline. If oil prices go up, that's good for Cathay. They make more money as a finance firm. And so they were able to hedge their risks both ways. But they got so good at this and so excited about it, and the Treasury people were so happy about their success in betting on oil prices that they overbet. They overhedged. They hedged and became speculators. And once they become speculators and they're going too far, now oil prices go down, it's unexpected. All of a sudden the airline management is saying, oh great, oil prices are down, our costs are going to be lower, we'll finally make money as an airline. And then they look at the finance people who are looking kind of sad. They say, what do you mean you just lost hundreds of millions of dollars in speculating on derivatives? We never told you to do that. Well, you did tell them to hedge. They just over-hedged. And so hedging can easily become speculation. It's not just Cathay that's fallen into this. P&G had some of this problem. Other very well-known firms have had this kind of problem. It's an easy, slippery slope to go from hedging to speculating. And that's a managerial problem, and it's a risk that you have to deal with and account for. These are just some examples. There are many, many more. These are just some interesting stories to illustrate the nature of this operational risk, which is it's unlikely, but it can have a big impact. Thank you.